Welcome, welcome, welcome. We're going to make this a fairly quick webinar so I can tell you what I'm trying to work on and see how we can collaborate. Feel free to jump in, ask questions, use the chats, and we'll be able to read the questions for you and answer all the questions we have. We are trying to do a subscription-based wealth generation strategy. A subscription-based wealth generation means that finding a way to automate how to generate money. Now, in America, most people have a 9-to-5 jobs. They get up in the morning, they go to work. At the end of the week, they earn some money. Majority of Americans live paycheck to paycheck. So what people don't realize often is that those paycheck to paycheck that comes in, even if they were to take it, put it underneath a mattress or something like that, because American economy system is built on the foundation of inflation, then that money loses value automatically. I mean, this is evident because some of you guys have been in the US for a while, like myself. And I remember when I was, 19, 20. I was 19 years old or 20 years old. Gas used to cost like 90 cents or something like that. Today, gas is like $4.50 to $5 in my neck of the wood. I bought my first house in Washington, D.C. for 100 grand. Today, that same house is selling for 700. So if I had worked for the past 20 years and I took money, every single time I took money, and I didn't spend it, and I was frugal, I was thrifty, I saved all my money to try and accumulate a lot, even if I made $100,000 a year, and I put that under my mattress, and I followed the system and the concept of frugality, discipline, savings, and things of that nature, in 20 years, that 100 grand would be worth how much? $2 million. But what I could have bought, future value of money, present value of money calculation, what I could have bought 20 years ago with $2 million is not the same of what I can buy today with 20 million. So even though my wealth is growing, my purchasing power is diminishing. That is, imagine someone making $100,000 and saving the entire $100,000. He would have $2 million in 20 years, and it wouldn't buy him anything significant. As opposed to taking $100,000 income and then buying one house 20 years ago, and today having that house be paid down by 60, 70, 80% at $1,000 increment or $1,500 increment per month, or something like a $60,000, $70,000 paid down towards the principal, and having that house now be worth $700,000, and you still had the ability to enjoy the income that you generated over the years. So my realization of this phenomenon is that my preferred method of generating wealth is to find a system that, one, hedges inflation. As inflation goes high, the thing that I'm putting my money in also becomes more expensive. So it balances out with inflation. That's number one. Number two, I automate my payment towards reducing that debt, or I automate my payment toward the savings of that system that hedges my inflation, towards the system that hedges my inflation. So because I bought my first house at 19 years old, I didn't have $100,000 sitting in the bank. And because I didn't have $100,000 sitting in the bank waiting for me, What I had to do is go to the bank and borrow the 100,000 to say, okay, I'm going to take your 100,000. I'm going to pay you 7 or 8% on that money, so that instead of me saving my $100,000, I can use your 100,000. Then I automated my monthly payment so that every single month, something came out of my account to cover the debt that I just took on. Now, I didn't change the property. The property was $100,000 in Washington, D.C. It was just sitting there. Today, it's this exact same property. Nothing changed. I didn't even do any major rehab in 20 years on that property. But because the cost of inflation, the percentage of inflation, the degradation of the dollar has happened over 20 years, my investment, my property is now worth $700,000 or $800,000. Now, the beautiful thing about some of these things is that when you automate these things, it doesn't mean that the money needs to come from you, the individual. In my case, when I bought that property, after 1 year of living in the property, I rented the property out and went and moved somewhere else. So for 20 years, someone else has been paying my contribution, my automated, my subscription on my behalf, while my equity is growing and my debt is reducing, so that, God willing, when I am ready to retire 10 years from now, I can tap into almost $1 million house that I planned correctly from the age of 19. The thing is that all of this is available to everybody. The question is whether people take advantage of it or not. I have conversation with people often that talk about, well, I had a life insurance when I was young, and I opted towards life insurance. Other people say, I opened a savings account or a education account for my child when they were a kid. Me, the strategy that I use is to use real estate and then leverage that, and then have that be the solution provider for me and my family, including my children's education in the future. So if we took a step back and we looked at the options that were available out there, at the age of 19, I could have went and got a life insurance. I could have went and got an educational savings plan. I could have went and got a 401k. I could have went and got an IRA or any kind of retirement account out there. The thing about those would be that I would have to create labor, work, generate activities and income, and then from that income, take a little bit out, deprive myself of what it can buy me, take a little bit out, and then go put it on the side. And when I put it on the side, if it's not a well-selected set of stocks, bonds, ETFs, or any kind of financial vehicles, then that could go up or it could go down based on my choice of investment vehicle. What I did was the complete opposite, where I said, you know what? Because I am African and I'm used to tangible things, things I can touch, see, and feel, I'm going to go buy a house. I know that the house is going to be there. There's going to be a title to it. And if I buy the house, I can generate income from it. I can rent it out, and then someone will pay the debt. So my contribution to the reduction of my debt doesn't necessarily need to come from me. It could come from someone that is benefiting or using the house for their interest. And then over the period of time, 10 years, 20 years, that house has now 7x'd under my name. And all I did was duplicate that process. After the first couple of years, I used equity line of credit, bought a second one, then bought a third one, then bought a fourth one. But what is beautiful about this is a lot of people always say the way to wealth the way to income, the way to capital, the way to prosperity is you have to work, labor, you have to earn, you have to save, spend less than you earn, and then you have to make the earnings work for you. I just wanted to change the work and labor portion of my strategy and I have to buy a property. It has to earn. And when it earns, make sure that I spend less than what it earned so that it can pay down the debt. And when it pays down the debt, build equity so that that vehicle that I chose, that real estate portion, generate passive income, somewhat of a passive income because someone still has to maintain it, but it doesn't have to be me, but it has to create some sort of passive income. And that income has to pay down the debt. And the equity is the debt minus the value, which grows and hedges the inflation. Now, typically you have to be careful how you do that because you can end up buying a property in a depreciating market or a degrading market, or you can look for certain signs where you know that that market is always going to outperform the rest of the country as far as real estate is concerned. But what is important is the automation of that vehicle that you choose the moment when you choose that vehicle. So how did I get started? The first thing I did was I created a plan. I said to myself, a 19-year-old young me, I said to myself, 20 years from now, I want to retire. 20 years from now, I want to have $1 or $2 million in my bank account and not have to work for anybody. So I created plans that was very, very clear, very, very defined with the timeline attached to it. That's the very first thing I did. Then I reverse engineer and figure out how do I get to the point where I can get what I want 20 years from now. How do I get there? And through that questioning, I researched and created a good understanding of different financial vehicles that I can use. And the most comfortable for me was real estate. It was the most comfortable for me because you can invest in stock, but you cannot leverage a high leverage on stocks. Unless you're a day trader and you have like a $25,000 or $50,000 bank account, leverage of stock is usually 4x. That was my discouragement with stocks. The second thing is that stocks are volatile and you see the price every single day. So if my stock price went up 20% and a year from now it drops 30%, I'm going to freak out. And I'm going to just press one button and exit the stock market. The volatility of it made my stomach faint. So insurance was something I didn't really believe in. I felt that my understanding of insurance was that I work hard and I go and I take my hard-earned money and I pay for life insurance, whole or term or whatever. That person that I pay uses the money. If something happens to me, they give me the money. But what happens if nothing happens to me? They get to keep it. Because of that limited understanding of insurance, I opted out of insurance. So the most comfortable thing for me was real estate. Now, it wasn't just any real estate. It was real estate that generates income. So I was not interested in land, even though there are certain places where you can buy land and the land can grow exponentially. I was interested in where can I put my money or where can I put someone else's money and then earn and then use the earning to pay the debt. If there's anything left over, thank God. If there's nothing left over, no problem. If I have to contribute a little bit, I know my contribution is a tax deduction. So I borrowed $100,000 and went and bought my first house. Within 3 or 4 years, that equity had grown so much that I could refinance and take money out to buy my second house. But the way I did it was I automated the monthly payment from my tenant to the mortgage company. Now, back in those days, down payment was 10%. So I had to have $10,000 plus reserve and everything else that goes along with buying a house. Today, average home in America is $400,000. 10% of that is 40 grand. Unless you never bought a house, you can do an FHA or a VA if you're a veteran and things like that. But you can only do that on the first one. After that, you have to now increase your down payment over time. So understanding the concept of leveraging other people, leveraging the bank's money, and all of those things can be concept that you can create that automation of subscription towards your money. The second thing is having the clear goals. The third thing is investment vehicle. So I talked about the clear goal for me was to retire 20 years. Second was the investment vehicle. I chose real estate and I explained why. Third thing I did was creating a budget. I created a budget so I could create a savings plan in case my tenant did not pay rent. If they didn't pay rent, I didn't want to lose the house. So I put 6, 7, 8 months of money reserve in case there was a problem with the home, and I put it on the side. I didn't invest it. I didn't do anything. I just put it in an account. And then I automated the monthly payment to them so that the monthly payment went directly to the bank so I can forget about it. And then I put a buffer in case they were late, it covers. Today, you don't even have to do that. Today, there are insurance companies that will insure the rental income of your tenants. And your tenant doesn't pay rent, they will cover up to 6 months of it. So your credit and the property is protected. So instead of saving 6 months rental income, you can pay a premium to an insurance company and they will pay in case your tenant fail to make their monthly payment. And then the rest is simply consistency. You just have to do that every single month, every single year. And in 20 years, you can have 5, 10, 20 houses that you sit down and you can say, if I want to retire now, there's absolutely nothing that stops me from doing it. Because every single one of the property that I have accumulated now have equity of every single property now has been paid down by my tenant. Every single property has a purpose or desire or something. And some of these homes may have been 15-year mortgage and they may have already been paid off. So I can literally sit down and say, you know what? For the rest of my life, I'm going to just enjoy my wife, my children, and not have to worry about money or capital or any kind of stress for life. Now, I wish I could say that that's what I'm doing, but I'm human and I'm greedy. So what I'm doing now is that because I've learned so much over the past 20 years, now it's just an ego thing. I just want to have a lot of money, reach an apex, reach like success that I could just brag about. So this system is a system that has worked for thousands and thousands of years. I'm not the person that invented, I'm not the first one that came up with this scenario, but here's what I'm trying to do that is somewhat unique. I am creating an investment club where we, me and my community, can come together and put a small contribution so that we as a community can do that system year over year over year over year. And this is what I'm thinking. I am thinking of inviting 250 people to join an investment club with me where each person puts $250 every single week. At the end of the month, that person would have contributed between 1,000 or 1,250 if there are 5 weeks in a month. If I have 250 people that does this consistently, every single month we can buy 1 home. At the end of 12 months, we would own 12 houses. Those homes will be rehabbed, fixed, upgraded, and they will be flipped on the market. They will be sold on the market. And me and my 250 investors will split the profit. We will just divide the profit among us and our investors. I am thinking that doing it this way gives us one advantage. The first advantage it gives us is what's called a dollar cost average. What that means is that because we don't know what's going to happen to the real estate market, if the market crash, we will buy more property at a cheaper price. If the market spike, we will buy fewer property at a higher price. So buying incrementally every single month allows us to do a dollar cost average. Selling the 12th property in one lump sum at the end of 12 months allow us to package the property and sell it as an investor to other investors that didn't want to do the legwork, that didn't want to go and pick the property, that didn't want to do the rehab. They're looking for turnkey investment properties that already have tenants in it. It does that for us. And number 3, we leverage now my knowledge over 20 years of doing real estate and my real estate license that I have in 13 states to be able to do this with my fellow investors and partners. I'm trying to put this thing together in the next 30 days. We created a list of, we had 95 people that are interested in signing up for this subscription. We're still looking for another 160 or 155 people to join us on this adventure. When we take the money and we buy the property, every single person's name is on an LLC. Hence, every single person owns the property. We are anticipating that if everyone invests $13,000 in this, not that it's not a lot, not that it's not small, it depends on the individual. Everyone's invests $13,000 on this investment. We're trying to give everybody somewhere in the neighborhood of 20 grand because that's based on past performance. We've seen where we've done project where we bought houses, fixed it up and sold it, and we made 40% return on the property. So if we do that and the property is $250,000 and we have 250 investors and we do this 12 times or $2.5 or $3 million worth of investment, we feel that it's possible for us to give a return of $3 million to our investors by sharing the profit with our investors. Doing it this way takes advantage of what I just explained over 20 years, but doing it on a weekly increment. So it would automate an investment every single week. You get your paycheck today, take $250, put it in it, and you do this for 52 weeks. And then at the end, you get a lump sum check. Just as if I was taking one of my first investment in Washington, D.C. that I paid $100,000 and I sold it today, I would get a check for 700 grand, which took me 20 years to do. But I'm trying to do the same thing at a shorter pace, the bigger group of people. Questions? I am open and interested in questions. Sorry, let me see if we have questions being typed. Who has any questions that they would like to ask about this program that I'm trying to put together? If you guys don't have any questions, can I ask questions? What do you guys think of the idea of collaborating with other fellow brothers and sisters from your hometown? What are your thoughts?
Hey, hi, this is Sansi. Yeah, can you hear me?
Mm-hmm.
I think it's a really like great idea to be able to invest. But I was just thinking about like 250 people, for example. So what insurance or what guarantee do we have to make sure wherever like we put our money, we're gonna get it back? Like, like we want to make sure like it's safe. That's a huge priority for me, for example.
Yeah, that's a good question. When we send you a contract to sign, you're going to sign, you're going to put your information on the contract. Your information is going to go in an LLC. That LLC, you become a member of a limited liability company. That means that when we go and we buy a house on a monthly basis, every single time we buy a house, we buy it under the name of the LLC. Then we send the members of the LLC a copy of the deed or the title. So you're going to see a title that is at the public record, that's at the registry of deed, and your name is going to be on it. In America, I think in every part of the world, even in Guinea, there is like, I think Guinea, there's tribunal de première instance where you go and you register the title or the titre foncier, the whatever you own. US has the same thing by county. So in the US, the county registry of deed will hold the title of the LLC. So when we buy property, you will know that we bought the property, and you will know the entity or the LLC that we used to buy the property. And when we sell the property, you will also know, and you will also be able to check on public record that we sold the property and how much we sold it for. So when we sell the property or when we buy a property, there's a document that is created by the lawyer called the HUD-1 statement. And that HUD-1 statement is a piece of paper that tells you how much you bought this property, what are the expenses, and how much you sold it for. In order for me to sell the property, the members of the LLC has to agree, and then we sell it, and then we divide the profit. So your money is always tied to a property. And then when we sell the property, an attorney is hired to divide the asset because they hold money in escrow. It's the same thing as if you hired me to be your real estate agent to help you buy a house, and then you gave me your money as a deposit because you're buying the house. I am required by law to put that money in what's called an IOLTA account or an escrow account. When I buy the property, we transfer the money from my account to the seller, and then we take title of the property. And it's the same concept if I am borrowing money from a bank. So if I go and I say, I want to use my house as a guarantee to borrow money using my house as the collateral, the bank will put the money in the escrow account or the IOLTA account of the lawyer. And then when I give them the title of my house, they give me the money. And then that trade is done and my title goes on a public record. And then the name of the bank appears as a lien holder or a mortgage to the money that they gave me. When I pay the money back, they give me what's called a discharge, and that removes their name from the title of my property. The same thing is structured here. This business idea that I'm proposing is a business idea that we've applied with the Securities and Exchange Commission of the US government. So they have already done all the due diligence, and you can literally see all of the documents and all the paperwork that we have filed with them. Right now, I'm taking a long time to answer your question, but I want to make sure that we are as transparent as possible. So if I go to, let's say, this website, which is the fund website, you can see all of the documents that we submitted to the Securities and Exchange Commission. So if you click on this document here, you can see what's called the Form C. Form C is the Securities and Exchange Commission based out of Washington, D.C. And you can see we have a SIC number, which is the intermediary number, and the SEC filing number. So we've submitted this, and we're looking for $250 from 250 people. And our target, we're trying to raise $5 million from our investors to do real estate investment. And this is my name, Marwan Ba. And the business model, the operating agreement, all the information is in here, including a bio about me, my background and education, and how long I've been doing real estate, where I am from. The whole shebang is in here. And of course, there's an audit from an independent certified public accountant that has done the audit on my business and on my person. And there's also all of the expense of everything that we're trying to do and the return that we're trying to give to people and the proceeds. When we collect money, how is the money spent? All of the information is in here. This document is done professionally. It was, again, independent audit report. All of it is inside of this document. Everything that you might be interested in is inside of that document. So we are doing, this is not a unregulated. This is not a, it's not a, you know, back of the hood kind of like between us kind of agreement, because I can tell you that most of the 95 people that are in the list of people that are interested in doing this are not even our people. They are Americans and other people that understand the concept of automation, they understand the concept of diversification, they understand the concept of investing, and they understand the security that real estate provides. So those people are the majority of the people that have shown interest in this program. But I can't do anything with your money without disposing of the assets, and then you will know because you're a member of the LLC, or when you put the money into the thing. And one other thing, the reason why I'm trying to do on a monthly basis is so that I'm never sitting with $4,000 or $5,000 or $6,000 of your money without it being guaranteed by some sort of real estate asset. The maximum I'm doing is 1 or 2 months so that we have properties that are in the pipeline every single month. That's the way I'm thinking about doing this. That's the way I structured the operating agreement. That's a good question. Long answer. What other questions can I ask? I kept you guys longer than I promised. It was like a 30-minute little webinar. I appreciate you guys staying. What other question can I answer before I let you guys go?
This is Mukhtar Bari.
Barry, how are you?
I'm good. Is it possible to see this document you was talking about and read it through before signing up?
Yes, of course. This document is online. It's already online. So if you go to mansourx.fund and then you click on SEC, you will see the whole entire document. If you go to the SEC website and you put my name, or you go to the sec.gov website and you put Mansour X, you will also see the document. So it's a public, this document is a public document, exactly like if I'm trying to sell you shares of Amazon or shares of Tesla or shares of, I don't know, GE. It's the exact same thing. This one is just not traded in the stock market, but you can have access to that document. If you text us if you send us your email, we can even send you the document on a PDF. That way you can have it on your information.
Can I send my email in the chat? Right?
Yes, you can. You can put your email in the chat, and Hector is going to send you the SEC form, and he can also send you a copy of the contract that we're sending to people so they can review it if they're interested. Alhamdulillah. If they're not, I thank you for your time, for joining and all of that stuff. and I hope to do business with you in the future. So, but yes, if you put the email on the chat. Thank you. Thank you. Yes, Hector will be able to send you all of that information. And because you signed up for this webinar, Hector is also going to send you a recording of this webinar so that you can watch it again and again if you need to, or you can share with your friends and family if you know someone that can take advantage of this. But you know, the reason why I'm starting this is because 20 years in the real estate business, I have probably 10 or 13 properties. I own 13 properties, being 10 years in the real estate, 13 properties. But I've owned over 25 properties over my 20-year career. A lot of them, I've sold them because I needed money, because I wanted money, because I enjoyed like the good things of life. But the 13 properties that I've kept required a lot of time, money, energy, a lot of skills, a lot of knowledge. I have a property in Massachusetts. There's an old man that lives in my property. He's handicapped. He pays below market rent. And because he knew that I was going to evict him, he sued me first. He took me to court first. Now the law says that I have to finish that lawsuit before I kick him out, otherwise consider retaliation. We've been going to court for 5 years. Now, if I am not an expert, an experience, or whatever, I would have lost that property a long time ago or sold that property a long time ago. So real estate is not as easy as everybody makes it seem to be every single day on all of these gurus on social media. It's not always hunky-dory. Sometimes real estate is really hard, and sometimes you can lose your shirt. The concept of this club is so that if we are doing this on a consistent basis with 250 people, we are diversifying the risk so that it's not me that's just taking all the risk, but it also means that I'm not taking all of the benefit. But the group can leverage each other and me to get good deals so that every single year we can go through 12 properties, generate income from it, add to the inventory of real estate supply. And then when we dispose of it, we benefit from the cash flow that comes in. And the money that you make is even taxed differently. So if you go and you work and you get $100,000 income, $100,000, you make $100,000, you're taxed at 35, 40% tax bracket. If you invest in real estate, you make $100,000 after 1 year, your tax bracket drops to 15%. So you get to keep more of your money doing real estate because it's an investment. It is not active income, it's passive income. It's an investment. So you retain more of that profit, that capital. So if I know all these things, I don't want to do anything else but real estate. I also don't want to be a person that raises money, that chases money, that, you know, I want to focus on the real estate. So because I want to focus on the real estate, if I have 250 people that's going to do business with me every single month, every single year, I don't need to go look for money anywhere. I don't need to go to the bank and borrow money. I don't need. And the funny thing is that everybody, including you guys, have savings accounts and checking accounts at the bank. Most people that I talk to have more than 5 or 10 grand in the bank account. And they keep it there for 1 year, 2 years, 3 years. And they get like 1%, 2% at the most. And then the bank lends it to people like me because I have 4 mortgages. My mortgages are basically me going to the bank and saying, can I borrow money to buy a house? And then they give it to me, but where do they get it? They get it from your deposits. So the idea could be, why do that? If you need money a year from now, not today, a year from now, or 2 years from now, you need money, take a little bit, put on a side, and make sure that it's working and growing for you without you doing anything. And then when the project is done, you get a bigger chunk. And compounding that, doing that again and again, on a bigger scale, on a bigger scale, on a bigger scale, always protecting yourself, always checking the documents, always verifying the title, always verifying the lien, verifying everything. That's how people become wealthier. That's how they become richer. I mean, give me 1 second. I want to show you something. I know I captured longer, but please just give me 1 second. Let me share something with you. I am doing a deal right now. Come on, where is this? I am doing a deal right now. I'm doing a deal right now. My name, my address, for $2.5 million, $2.3 million. This money is going to cost me in interest $220,000. And the closing cost is $55,000. That's the breakdown. 220 and 55, that's $270,000 for a $2.5 million that is going to go to do real estate project. Now, let's just be honest with each other. Who would I prefer giving that money to? Do you think I would prefer taking $220,000 plus $55,000 in closing cost, 270 grand, to use $2.5 million for 1 year? Or do you think I prefer raising 2.5 million with 250 people, each investing 5,000 or 10,000, and then sharing with those people 250 grand? Which one do you think I would prefer doing? So if I can go outside and get 2.5 million to do a real estate transaction where I'm going to pay $270,000 to somebody, it's because the upside, the profit on the back is more than 250 grand. Do you guys understand? If I'm going to take my risk, my reputation, my credit to go outside and raise $2.5 million and then pay 220 in reserve and monthly payment or interest or whatever, and pay a closing cost of $55,000, that's 270 grand. To use $2.5 million in 1 year. And then alternative would be for me to have 250 partners and then have each one invest, let's say, 10 grand. That's 2.5 million, right? And then share the profit with that group. Which one do you think is better? I can tell you, for me, I would prefer sharing my profit without having to go through all of this, because that letter is 10 pages long and there's all these stipulations I have to go through, all these dance, all these conditions, all these terms and all these agreements, all these things that have to be done before they give me the money. And what are they doing? They're taking the title of the house and putting their name on it and putting it at a registry of deed. I am doing the same thing with you guys. I'm creating 250 people, taking their money, and when I buy a house, I put everybody's name on an LLC, and I put it at the property. So the protection is the same. And then on this one, we share the profit. On this one, I pay them something that I promised I would pay them. If I don't do it, they take the house. That's the way it works. And that's how I bought my first house at 100 grand, my second house at $500,000, my third house at 750. Until now, I'm doing $2.5 million deal, $5 million deals. That's how I got to that point, by incrementally doing every single and growing. But I can tell you, It's hectic. I can tell you that if any small mistake happen here, they're going to take the house. So I can't afford any mistakes. If I make a mistake on this side, because we share the profit, I can call everybody and say, hey, something bad is happening over here. I need you guys to be patient. And I'm sure that most people will be understanding of that. But when we're done with the deal, everybody's going to get a bigger cut. Anyway. So that's the story. Any other question before I let you guys go? We've been on the call for 50 minutes and I only told you I was going to keep you for 30 minutes. I'm sorry. Any other questions that I can answer?
Can you also like share maybe your phone number in case we have like any follow-up questions? We can maybe call or reach out to you, to have more info.
This is my phone number. I just put it into the chat. Everybody should have it, no problem. And I am in Massachusetts. So if you guys are in the neighborhood, please stop by and visit and we can chat.
I also share our YouTube channel. Please go ahead and check the videos that we have and subscribe if you like it.
That's only, we have 2 YouTube channels. So there's the real estate partner. And then because I teach real estate to real estate agent, we can't neglect that one. So sign up to the second one too, if you want to like learn what I teach the real estate agent, because I teach real estate agent how to obtain their real estate license. I've been doing that for 17 years now. So yeah. Yeah.
You said you share already your phone number in the
yes,
chat?
I did. Yes, I did.
No, I can see it.
Hector, can you put it in there?
The phone number is not there.
It's not.
Oh, it's not? Okay. So let me
Okay,
see
now.
everyone.
Yeah,
can
I
see
already,
now.
I already shared.
Okay, thank you. I think I was just sharing that with the panelists. But yes, so my phone number is 617-785-8571, 617-785-8571. That's my cell phone number. You can reach me, directly. You can reach, hey, Mr. Buddy just called me. That's my phone number. So you see, he called while we are live. Okay, so that's my phone number. And then obviously you can send me phone call, text messages. You can reach out to me directly. And honestly, I'm just looking for 250 people. And I feel like if we have the 250 people, we can build something really, really incredible, Like, I don't know if you guys know this. Do you guys know who the richest man in the world is or was? You guys ever heard of Warren Buffett? You guys
Yes, yeah.
You know how Warren Buffett became the richest man in the world?
I don't know all this story, all everything, but I know a little bit about him.
So do you know how he became the richest man in the world? If you're going to say it's through investment, you'll be wrong. Warren Buffett didn't become the richest man in the world because he invested in the stock market. He became the richest man in the world because he had an infinite amount of pool of money being deposited every single day or every single month through his insurance company called Geico. So if he invests an unlimited amount of money, because every single person that drives and has insurance with Geico pays him money, and he takes that money and invests, his annual return on the stock market is 7%. He averages 7 to 10% every single year. 7 to 10%. Can I make you the richest man in the world? 7 to 10% on a lot of money can make you the richest man in the world. So what am I doing? I'm looking for my Geico. I'm looking for people that are going to pool money together. But instead of me keeping it like he's doing, I want to share with the 250 people. I'm trying to invest. I'm trying to create an investment club. That's it. So if you guys are interested, let me know. And then hopefully we'll make money together. Hopefully we make a lot of money together, inshallah. Because that's the reason why we are in America, right? If it wasn't for money, I can tell you exactly where I'm going to be. I'm going to be in my little village in Telemile, looking at the kunkure, going to fish, planting something, chilling, relaxing. But because I want money, I came to America and I'm still here, right? But if it wasn't for money, I'd be there. I guarantee. So I'm looking for 250 people that want to go on an adventure and make some money. So if you guys are interested, please let me know and let's make some money together, inshallah. All right, my people. Thank you so much for joining. I'm not going to keep you for an hour. I promise I'll let you guys go. If you have any questions, send me a text message, call me, or reach out to Hector. Join our YouTube and social media, and we can continue the conversation if you are interested. Okay.